Hello, welcome to this video where I will discuss something I've recently been working on. It came up the other day that I was working on this. I've been talking about it for a while, and someone asked if I could do it in video form. I said, my analysis, that is, and I said, I think I can do that. So, this is my, I call it ATR project. Real quick, if anyone probably puts out any of these type videos, this isn't financial advice. I'm not a financial advisor. This is me telling you some data I analyzed, what I saw, and how I'm planning on implementing this. What you do with it, it's up to you. Another is that I only looked at the SPX. This could work on other products, equities, ETFs, etc. I don't know. I didn't check. My guess would be it does, because the reasons why this works is the same. And another disclaimer that I didn't put in here, but I'm not some sort of data scientist. I'm a guy looking at charts with an Excel worksheet. So take it with a grain of salt, I suppose. Alright, so what are we talking about today? Talking about what this actually is. I'm going to explain it, give you some examples, go over what the data showed. I'm going to show you some historical perspective, go through a bunch of times when this thing actually happened, and then some ideas that I intend to implement as far as the strategy goes. So what it is, I use this SATI ATR indicator. If you don't have it, check out that website. I went to position mode, which gives you the quarterly ATR, right? An ATR for one whole quarter, average true range. I noticed a sort of pattern every time that this happened, and so I wanted to verify that this pattern was real and I wasn't just imagining things, because, well, I didn't want to be a tinfoil hat kind of guy, even though maybe it'll seem that way as we go on. So, what I'm talking about, so on the surface at least, it looked like whenever the SPX here interacted with this -1 ATR level, you get an exaggerated sort of snapback. So I thought this could be an interesting strategy if you knew what you were looking at and could use it appropriately. So here's my example, right? This is in 2009, the bottom of the Great Financial Crisis, interestingly enough. And what you get here is, right here is your -1 ATR range. What you got first was one interaction with it here. You can see it came down, it bounced off, and then the next day had a pretty big green day comparatively, and you got a little bit of further follow through before coming down, right? So this right here is one move you could play, but then the real big one is it came down, and then right here, when it comes back up out of the range, you can see that it just goes on and on and on for months, right? A long time. I only have, actually this is several months, so you can see that you got this really big move, and really it's just because the price was, pretty extended from here. So this is the method I used, right? I went back through these charts, I looked at every time the SPX interacted with this -1 ATR on the position mode. Again, that's the quarterly ATR. I looked at all the available data from now back through 1962. Anything prior to 1962 only had the closing prices, so the data would have been inconsistent, so that's as far back as I went. If you wanted to, you could look further back. It would just be slightly different as far as the results that you get, but the pattern does look similar, but I wasn't going to try to analyze it because it just would have been a little different. Alright, so then what did I look like every time? So how long it was below the range, what level it reached afterwards, so the next relative high. This was a little subjective, but I just picked a high level somewhat after that before you got some sort of pullback. So sometimes it's pretty obvious what the next high is, sometimes it goes on for a while and I have to say, okay, here is what I'm going to consider this high before it pulled back some. How long it took to reach that high, right, that'll tell you if you are taking a position, kind of how long you might expect to have to hold it, what percent change you got. So in this case I used the -1 ATR level, clearing that as the base. If you were to start your position at a lower point, obviously you would get more percent change, but as far as a safe, in my analysis, safe level, it's clearing that ATR level. And then if the price rebounded back up to that mid-put level, this, upon initial review, looked like a pretty common target. So I saw how often it did that. If you don't know what I'm talking about, real quick, this is the put trigger up here, and then the mid-put is this one in the middle, between that and the -1 ATR, this line here. Yeah, a small hitch, right? Sometimes this ATR range does shift, right? So while you're below the -1 ATR, the quarter will change over. This kind of does confuse some of the data, so I looked at it with and without those occurrences. And then for analyzing the moves, I used the first candle of the new quarter as the base price, right, wherever that opened, and analyze from there. That's partly why I did analyze it separately, because it's sort of a different move than the rest of them. Okay, then I broke each occurrence into different categories to allow for analysis of what they do and how they move, because the further below the ATR, the longer you stay, you're going to get kind of different moves. So here's what they are, right? Price category 1, you touch the ATR but bounce off of it. 2, it briefly dips below the ATR, comes back above. 3, so this is under the -1 ATR for more than a couple days, more than a few days, but doesn't go really deep, so it doesn't, and I categorize that by the second ATR extension. And then category 4 being it did reach that second ATR extension, 5 being that it closed below the -2 ATR level. These are pretty deep, there's only a few of these. And then F, that's a failure. So in this case, it did not exhibit the subsequent rise after the range. I give it about a week, right? So some of these, it'll come out of that ATR range and continue downwards, but you will get a little bit of a bounce a lot of the time. In this case, this F, that didn't happen at all. That is a rare occurrence. All right, so some examples of each category. Category 1, you see you're going along here, hits this, it wicked down to it, and just bounced straight off. So that's a 1. 2, there's a couple of these here. You see, you start all the way up here, had this really violent down move, but then once it reached this ATR range, or this ATR level, -1, wicks below, closes under, but the next day closes above, and then again wicked under, but stayed above. And then you got the same thing right here. It wicks under for a couple days, closes under once, but then comes back above. This also did involve an ATR shift, but it was also at the same day it cleared the ATR. All right, your category 3, there's several of these in a series here. It comes below, stayed below for about 4 days. Again, a few days here, and then again a few days here. This one right here came down to this first extension, as did all these. And then your 4s, these are pretty deep ones. This comes down, gets all the way down here to this second extension, goes below it, doesn't quite reach the -2 ATR, and then snaps back up again. This is another one of these ATR range shifts. Your 5s, these ones are pretty nasty, right? It hits this one, the -1, here's the -2, and it closed way under. And then your failure one, right here, the range shifts. Right here, the open is, here, this level, and then the close is down here. And then, so if you just bought at the open here, you go out a week, I mean, right here, you could have, in theory, been at a higher price than the open, but that was pretty marginal. I wasn't going to count that one. So this is the only instance that you're going to see of one specifically like this. And then you saw it in a couple ones, but this ATR shift right here goes under the -1 here, and then the ATR shifts here. And as you can see, if you bought at the open here, it went all the way up to here before having a little pullback. Okay, so here's all the data, right, for category 1. I'm not going to sit here and read through all this. This is if you want to pause it here and take a look. But as you can see, there were 30, that's neat, 37 instances of this. How long under? Less than a day, right? These are bounces. There are a couple where I grouped some together, so these did bounce off, but it was bouncing off for several days in a row, which is why there is an average here of less than 1. The percent change that you see, right? So this is after getting above the ATR, 6.27. How long this took? About 9 days. This is going to come up later in a summary, so I'm not going to go through this whole thing. But category 2, you can see that there's 21 of these. This one, 21. Why is this first? Well, that's because I noticed it after I was going through the rest of them, and I wasn't going to go back and renumber everything. For category 3, there was only 15. Category 4, 11. 5s, there's 7. And failures, there is 1. Right, so as you can see, it kind of makes sense. The deeper the move, the less frequent it is. All right, so this is the summary I was talking about, right? So each category 1s, it's about 41.5%, 2s 21.3, 3s 15, about 16, 4s you got about 12, and 5s you got about 8. And I remember failures, there's only 1% of the time roughly. Right, how long did these stay under? Again, 1's less than a day, 2's about 4 days, 3's 8 days, 4's 27, 5, 54, right? These are really deep, it's going to stay there a long time. So what kind of rise do we get after the ATR? Well, 5s, you get a big one, right? Because this is a long time, but anything else, 5 to 6%, which is still a pretty decent move on the SPX. And then if your ATR shifts, you can see you get about 11%, which is kind of where this 5 came from, because every 5 involved an ATR shift. And then rise time, the longer the event that occurred, the longer it takes to get to its end time. And then how often do we reach the midput? Well, for the category 1s, it's actually 75% of the time, and the 2s 55% of the time. So some I'm going to point out later, but whenever you were trying to figure out what kind of interaction you have in real time, odds are it's going to be a category 1 or 2 based on the fact that it's almost 63% of the time. Okay, so what are we going to look at? I'm looking at a bunch of charts, and this is the SPX. This is what my charts are all based off of this chart. As you can see, I've labeled every single time that this occurs throughout this whole time back to here, 1962. Before here, like I said, data gets kind of muddled. I did leave this Fibonacci for this entire time on here. This is from the Great Depression, or the stock market crash of 1929, the top to the bottom of that, and you'll see as we go through that there's some odd interactions with these levels, so I left it in there just because I thought it was interesting. You may or may not. This is the tinfoil hat part that I mentioned earlier. Okay. Yeah, that. Okay, so what I did, I included every chart that I found, every interaction that I analyzed, so that we could look at it and see the patterns. And then I left this pivot ribbon installed. This kind of lets you look at the price action, how it's going when these moves occurred, how violent the moves were in some cases. So I left it on there. So let's dive into this here, right? So this is in 1962. This is the first one I found. And this is the first move, right? I labeled them all, right? 1 tag 1 being the first category 1, 5 tag 1 being the first category 5. So what you got is you're coming in, you hit this one, you bounce up, and you get a move of about 3% off of this here, up through here, right? Pretty decent move. And then 5, you can see this went all the way down here, cleared the ATR, and gave you a good 7% move. So pretty solid from here up to here, 7%. Okay, I want to zoom out, look at this whole range between 1963 and 1982. You can see you're pretty range bound between 80 and 120 this whole time. A lot of stuff happened that kind of kept it in this range. It's kind of an interesting time period. But this is what we're going to be looking at for the next while, because it stays in here for many years. So again, we're here in the 1965-1966 bear market. Nothing really caused this other than kind of a technical correction after World War II. People kind of got the idea micro was overvalued, and this just sort of what happened. So 1 tag 2, we got another 7% rise off of this right here. It touched here all the way up to here, 7%. You can see that it went way past the mid-put trigger. Okay, 1 tag 3, it bounced off here all the way up through here is a solid. No, I didn't use this. I used it to about here, so about 5%. But again, you could have held it on all the way up here and got a nice move. But this is over, several weeks. For that, all right, 1 tag 4 here. All right, you got into this kind of sideways movement here, but again, it doesn't actually run into this ATR again. So 1 tag 4 did not give is another about 5% here, right? So you're kind of seeing 5% is a pretty common amount on these little moves here. Down here we get 2 tag 1. This one is 2 tag 21. This was the one that I found later, mainly because I was looking into this 4.1 and realized that it actually bounced back above right here. So that one was about 3% from where it cleared on this candle up to here. So something to note is on these little moves that it runs into the your moving average, your EMA, whatever you want to call it, right here, and that stops it. So sometimes in these moves, the best place to maybe take some profit would be once it gets back up to these on your daily, right? Because when you get down to this area, you're probably fairly extended away from your daily, so that'd be a good place to maybe look into taking some profit. All right, 4 tag 1. This first time we get down to this second extension here, it doesn't really stay there. It bounces off it. You'll kind of see that a lot. This is getting really far down. So unless something real crazy is happening, these are about the lowest you end up with. So this one cleared the ATR range. It tried to clear it here, but it just bounced off of it. So this should not have triggered you into taking any action because it doesn't clear it, right? And then it comes back. We clear it here, and we get about about 5% on that one too. And lastly, down here is your 3-tack-1. This is this move right here where it goes back under, pops back up briefly, but then doesn't close over. So you could have been faked out. That's why I intend to, when I use this strategy, look at a closing value. Right. Okay, here the ATR range does shift. If you use the opening candle here, you're kind of feeling pretty sad when it comes all the way down here. It bounces off here. But then, like I said, within a week, you're coming back up this way. So this one was about a 3% move from here up through here, but you would have had to sit through all this pain. So if you're willing to sit through that, you got that. All right, 1968, we got a few things going on here, right? Fed's rising rates, the government doing a lot of spending on the Vietnam War. There's a lot of concerns about that, so the market decided to pull back because of all that. It bounced off this a few times here, 1, 2, 3, 4 times, but didn't really stay below it. So this was kind of a shallow move. You could have got a few moves off of this, right? So here, this is your first time hitting it. You think it's probably not going to stay under, so you could go along here and profit all the way up through here where it hit the mid put, conveniently enough. This one hits here. You'd want to be more cautious because you know it just hit it back here. So I would wait till you come out of the range, and you didn't hit the mid put here, which is unfortunate. It got rejected by your EMAs. Comes back, goes under again, hits it again this time, still couldn't make the mid put, and then finally clears it, goes all the way up here, right? So you got a couple of small few percent moves in this case, around 3 or 8% in one of the cases. 1969. The only thing going on here was the Fed kept tightening, so you got this nice little move here. Bounced off the ATR. This, in theory, might have been a Category 2. Now I'm looking at it again because it went way down here. But regardless, it was still less than a day. And like this is one of those ones I was talking about, just violent snapback, where it went way up here, right? Hits your mid put, goes even higher, and then you get this pullback and it keeps going, right? So even up here at this relative high here, yeah, you got a 5% move. Okay, 1970. We had a tech crash similar to the dot-com bubble. Talk about computers. Computers were all the thing at that time. Computer companies, HP, interestingly. And then this is also Nixon effectively caused a recession to try to cool off inflation. Arguably didn't work particularly well, but that's not the point. So this is your first Category 5 that we are going to come across, right? It is actually here. So notably, you actually had a didn't get this one. This is actually a Category 2 right here, right? It goes under, bounces all the way back up here. So you're going to see that pretty much every time you've got a 4 or 5 is right before it, you're going to end up with a category 1 or 2, which I'll talk about later. But anyway, you come under here, and you just keep going way under the -2 ATR. It doesn't clear. Finally, the ATR shifts. If you go long here at this candle open, again, you get a little bit of pain, but within a week, you're back up above it. And you get a pretty nice move from, we'll say, here up to this point. And that is kind of a 3% move. Alright, this one is 1973. We look at the collapse of the Bretton Woods. That's the international monetary system that had been agreed upon in 1970, or at the end of World War II. And Nixon basically nixed the gold standard, and that collapsed this whole system. So international monetary system was collapsing. That's a pretty good reason for the stock market to do this, right? So looking here, 4-2 again. These didn't close under, but you did have a interaction here where you had basically a category 1 before your category 4. So here came down, it came back up, it did come back over, and you got this closing candle above, which in a strategy I talk about, you might have decided to go long because it closed above, but you would have got stopped out pretty quickly because it just dove back below immediately the next day. And again, this does clear before the ATR shifts. It's pretty close, and then runs back up here. So again, you get a several % move here. Pretty nice. Oil crisis, 1973, 74. This is all in addition to the whole Bretton Woods collapse going on at the same time. So lots of stuff going on in the throughout the whole 70s that is pretty problematic. Inflation's running rampant. Anyway, like we talked about, I kind of just consider this all this one move here, but if you were paying attention at the time, you would have seen hits the -1 ATR, bounces, does come up a little bit, so you got a little move here. This could be your category 2, and then it comes down. This one doesn't actually get to the -2. It's pretty deep, but possibly should be a category 4. And then again, the ATR shifts. You go long here. Again, you're sad for a couple days, but look at this. Within a week, you're all the way up here. This is a pretty good move here, right? 10%. Silver Thursday, March 1980. This was kind of funny. A couple brothers tried to corner the silver market. They at one point owned 1/3 of the silver available on the market, but then it drove the price of silver up so much that people started flooding the market with all their silver. It caused the price of silver to collapse. These guys got margin called, and that caused this whole event because they had to sell a bunch of their equities and stocks. These guys were billionaires, and they ended up declaring bankruptcy. Anyway, bounced off your ATR, comes up, get a pretty reasonable move here of 7%. 1980 to 82 recession. Paul Volcker defeats inflation is what I called this one, right? Paul Volcker was, I spelled his name wrong, there's a C in here. The chairman of the Federal Reserve that was specifically brought on to defeat inflation. He raised interest rates up to like 20% at some points to try to defeat inflation. So if you're, mad at Jerome Powell, just remember this guy was he was something else. So anyway, moves you get right here. You get a bounce, comes up into this cloud, doesn't hit the mid put, unfortunately, but this is your move prior to your bigger move, where you hit it here, your ATR shifts, and you get all the way up here. So this is a several percent move. Here in 1980, again, this is all part of the same thing going on. Hits it here, goes under, and you get a couple closes. It dips below again, and then you get this nice move up to your put trigger, mid put level. Sorry. And this one would have given you a good percentage if you had opened it along here. Okay, that was that whole time range, so we're going to zoom out all the way from 1983 to 1997. As you can see, this is a pretty nice bull run going on. So the times that it interacted with the -1 ATR are not that many, because it kind of just went up this whole time till you kind of neared the end of your bull run. You can see it kind of ramped up here, and you got a few kind of volatile actions down here, and then weirdly enough, once you got to this ATR extension level, kind of got volatile here too. Alright, so here we are in 1986. People are still worried about inflation. They got some good retail sales numbers, so they thought, oh no, the Fed's going to stop lowering interest rates because the economy's being good again. It's pretty funny because that's what just happened on a jobs report we got. And then computer trading, right? This was a new thing. It contributed to this whole loss. So basically, now we have circuit breakers to kind of stop this from happening. But this was a kind of self-perpetuating event where, you know, people start selling, hit stop losses, computers sold, drove price down, hit more stop losses. And eventually you get this giant move from all the way up here down to here. It did get kind of caught at this ATR. It closed below it, but then it bounced up. You got a really, really nice move here. Yeah. This one is roughly 2.5% here, and then this one, once you shift ranges up to here, is about 3%. All right, Black Monday. Stay away from this one, right? Don't get involved with this. If you are sitting here and you're like, okay, we're coming up to this ATR, and it just blows through it like this, and it doesn't interact at all, and it just, sorry, this one, right? It sort of stopped at this day, but then the next day when you say, okay, I'm ready to open my position, and it just straight blasts through down to this second extension, right? Get out. You don't want to be a part of this because, well, look what happened, right? It just super dumped here, right? And it stayed below here for several months. And even when it cleared it, you did get a little bit of a move here, right? So this move did get you about 6% from this open to this high up here. But if you were counting on entering here, you're going to be sad because it did just, when did it clear this? It was a while. You'll see in the, if you look over the actual data that I have, I included the dates when this cleared on a lot of these, but for this one it was a while. So, as I was saying, this is a bad situation. You don't want to be involved with that. Okay, so here we are in the 90s, early 90s. You got high rates, you start to get some poor earnings. This is a prelude to the recession and this Gulf War going on over here, right? So we get here, you get a couple of touches here where you kind of bounce off, go back up to mid put, bounce off mid put. This one goes further if you were still holding. And then you got this deep one here. Again, you did get a bounce right when it hit it, so You get a little category 1 or 2 again. Boom, bounce. It did, right? You got this really deep one down to this second extension. Did look like it tried to clear the ATR, but couldn't manage. So, again, this is why I'm going to only enter on the closing candle being above the range, because he could have got faked out here. And then your ATR shifted right here. You got a pretty solid move right up to the top of this EMA here before coming back down into the same range that you actually saw us crash from in 1987. So you see, we haven't gone very far since 1987. This move here was about 5%, right? You got about 6% off this one, about 5 on this one. Okay. 1996, we had some poor tech earnings, right? This is, interestingly, the run-up to .com bubble, but we had some poor tech earnings, and we thought, oh no, we're heading into another recession, right? They just had one a couple years back, and it was still fresh on their minds. So we got this one down here, 3.2, and this one, where you hit it, you went all the way down here to this second extension in one day. So if you had been, appetite for risk, you could actually add it on a position all the way down here and rode all the way back up here. That would be a nice move. Didn't quite make the mid-put trigger. So, again, mid-put level, sorry. So this is roughly 5%. And then this one right here kind of goes under, but it's under for like a day. Do you close up here, all the way up here, you're looking at 6%. Okay, so that was that whole range here. Now let's look at the 97 to 2010. You can see again, this was another, we went pretty far, but it was kind of a whole sideways move for this whole more than a decade, right? 97, we get the run up, the .com bust. Interestingly, the whole run up before the GFC, Great Financial Crisis, in case that wasn't clear to anyone, it didn't interact with the -1 ATR once, but we're into the end of this bull run through the 90s, 80s and 90s here, and it starts getting real volatile, and it hits it a bunch of times. So I just thought that was interesting that this one, no interactions here, a whole bunch. Also, tinfoil hat, check it out, right here. This fib level X support here, it dumps below it, but recovers real swiftly. And then here you can see we start getting real trouble once we get above this level. And again, same thing. Interesting, huh? Anyway, alright, so 1997, they call it the mini crash. It went down pretty hard, but then inexplicably, this is a Wikipedia article, just says prices came back up. This is actually caused by a European or a Asian market crash, and you got a pretty good move, right? You clearly went all the way back up to this put trigger. You notice it came really fast, which is you were pretty far away from your EMAs, so that kind of fueled the part of the violent snapback here. This one gave you a good solid 7% move here. Okay, so here we are in 1998. This is your late bull market volatility. There's also a Russian debt default problem going on here. People just are, well, worried about the market being overvalued for one thing, right? So you get a bunch of interactions here. 1, 2, 3. They bounce. They hit the mid put, bouncing around the mid put level, and then finally you get a pretty good solid move all the way down
below your -1 ATR, you actually closed down there one day. Maybe this is a 5, but it didn't seem all that violent to me, even though it was all down here. The 5s I like being like way down here. This one you see it did clear it up here. So what is 98? Yeah, 1 second. I'm trying to find the. Yeah, you get a 12% move off this. So in this one, it cleared it here, but it closed back below it. So I actually counted this when it cleared the ATR here. You open it here. Again, it keeps going down. It actually hits the -1 ATR again, but you could consider this all part of that same recovery. So that's what I did for this one, is that it was down here. But again, I used about a week. So 1, 2, 3, 4, 5, 6, 7. See, it's starting to recover at about the same level here. And took off. So this one, 117 here, I counted this as part of the same move, but if you were pretty quick on the draw, you could have got in on this one. And when it cleared, which it barely touched it, you would have had a nice move here too. All right, 99. I call this prelude to the pop. There's inflation concerns. Again, this is all just late bull market instability going on here. You got this touch here, pushes it all the way up past the put trigger. Pretty nice move. And then it bumps it a couple times. This one here, not the best move. Didn't even make it up to the ATR level, but you still got 2%, so not ideal. And then this one here, the ATR shifts and you get a nice move up here of about 5.5%, so pretty good. All right, so here we are at the .com bust beginning. There's so many of these here, right? Hits here, bounce up, get a good move here, up to the put trigger. Here we stay below for a few days. So you see this kind of sideways consolidation around this level, which is actually we're getting kind of in the present time right now. It actually went back down to this extension level again before coming back up to the mid put level. Same thing on this one. It's mid put, and it actually rockets up. So this one, if you cashed out the mid put, you might have been a little sad if you didn't leave a runner. So that one gave you a nice move, about 15%. Okay, so here again, the real trouble starts. And we get this deep move here real fast, but bounces up real fast too. And then same here, it really is just likes this actual put level here. So these ones pretty solid moves. If you can get in on these, you're looking at 13, 12% moves on a bunch of these. It's pretty solid. Okay, .com bust keeps getting worse. So time goes on, these ATR levels keep shifting down because, well, price keeps going down. But you get some good interactions here. This one, if you got this wick here all the way up, you probably wouldn't have wanted to take profit on here because it dipped back down. But even to here, we're looking at the end of 2000 here. Yeah, it's about 6%. Pretty nice. And then right here, you got a pretty deep one. It's the second extension eventually. Like I was saying, you close below and then come back above. So this is sort of a category 2. Again, I just grouped it as one move, but if you're in there real time, you could say this is a category 2 move. I got a little bit of upside here before reversing. You'll notice it didn't really hit anything here, so this probably would have been hard to play, but if you had added, say, on the reversal down here, you got a decent move up to here. .com bust, it just keeps getting worse, right? So this is actually the September 11th, 2001 is this little day here. So kind of interesting that it was already in a really big downtrend. It actually hit the -1 ATR here, and that did not help matters at all, right? As you can see, just obliterated. But ATR shifted. We got a pretty good move, maybe to here to this cloud, or if you'd held, you got all the way up here, and really it went up a long time. This is probably one of those nice bear market rallies I like to tell you about. Okay, but eventually, sadly, for anyone who's invested at the time, keeps going down, unless it's actually the same. Now let's slide that over. Forget this one. Okay, finally we find a bottom of the .com bust. This is right. You get this one little touchdown here, bounces up, gets a nice move in the middle of your EMA cloud. But here you get the one failure that I talked about earlier in 2002, right? So the ATR shifted. If you'd bought it this open, it closed down here, and you could have potentially seen a small amount of profit if you took profit up here, but right, it was about at this middle of this pivot here, 21 EMA. But I didn't consider this good enough to call it, so I didn't. Okay, anyway, keeps going. Here's the bottom. It hits this 2. It's a nice move back up to the mid put again, and then the same thing over here. This one, it does, as the ATR shifting kind of goes below. I didn't really count this move, but maybe you could. If you did, you got a nice move on the first day out, so still pretty reasonable if you're following a strategy that I'm going to talk about. Okay, so like I said earlier, the next time up is the Great Financial Crisis, and interestingly, this one has actually less interactions than the .com bust. Kind of just was more straight down, as opposed to having a lot of bumps and dips that the .com bust did. So it's kind of starting here, end of 2007, you get this pretty decent move here, bumps into this, gets back up here. So 2007, yeah, this one's a good 13% move from here up to here. Then you got another one here. That gives you a pretty solid move here. This is probably where I'd call this one. So that is a 8% move, almost 8.5. Okay, comes down, hits it down here. You got some real strong wicks. Oh, look at this little fib level. Tried to hold it up, and I'd say it did pretty well. It hits mid put again, like we talked about. So as you've seen so far, this mid put is pretty good. We looked at the percents earlier. It hits it a lot, unless your ATR shifts. If your ATR shifts, then it's just not going to hit it. Okay, another another 3 here. It goes down, stays here for a while. It's back up. You get a little chunk off this one. Right, this is 2008. Yeah, 1.2% move, so it's not a huge move, and you get a reversal back into this one. But look at this ATR shifts. Look at this candle. That is solid candle. And you get a little move up through here. So that one is a 10% move right there. You cut that one. Okay, great financial crisis. This is the Lehman moment. The bad gets worse. The thing that everybody thinks is going to happen again, but I'm not making any predictions as far as that goes. But as you can see, came down, we touched it, and boom, that was a nice move right here in late 2008. Which one was it? September? Yeah, also a 10% move. We get a pretty violent move down through here. Since this was all in one day, this is probably not one you want to get involved with. But if you did, you can see that you could have eked out a solid 2-ish% right here. I personally, if this was how I saw it happening, I would not enter at this ATR just because it's way too violent. And a lot of these are going to look violent in the time, but this one is excessive. And then we finally get it. The ATR shifts, so it gets a little breathing room, can just push down again. And this is, again, not the bottom. And it goes all the way down here. And this is down almost the minus, or below the -3 ATR. Again, we found this fib level down here. Look at that. Closed below this once, and then didn't like that. Came back up below the -2, which, if you were thinking about it, it's near the end of the quarter. You might think, hey, I'll get a little move off this, which it got a reasonable move. You actually cleared the EMA cloud. And then here we are at the end of the quarter. If you went long here, you get this move up to here, which did give you almost 5%. So even at the depths of despair down here at the end of this great financial crisis, nearing the end of it, I will say, found a nice 5% move right here. Okay, and then here is the actual bottom, right? This was the end of the last one right here. So if you had held through here, you'd be pretty sad because it can't come all the way back down here below the first extension of this -1 ATR again. But it did get another bounce right here into your EMA cloud. And then below here, all the way down below this extension. These are a bunch of trend lines, don't worry about these. And then look at this. Solid move. So good. And this just went on. It went on for a long time. Right, this one. Yeah, 27% move over the next 205 days. So I don't recommend. I certainly wouldn't plan on holding for 205 days, but if none of these are necessarily meant as a super long holding position. So even if you just went from here and you said what's a good level, well, it did hit the midpoint, right, which is a good place to start, and then it did come back down to your EMAs here, so you might say, okay, that's enough for me. All right. Okay, so that was that whole time frame. Now let's zoom out, check out. This was the end of 2009 right here, that last little bit, and then the bull market that we are currently possibly in still, questionable. maybe coming to an end, who knows. But here it is. You can see if this is anything like 2001, or leading up to 2001, the end of 99 actually, we're getting a bunch of these interactions here. So this could just be end of bull market instability, where we eventually are going to turn back around and make another high. There's really no way to know, but I just want to point out that in 1999 it did similar, where we were interacting with this a whole lot. So I'm not making any predictions off of this, but that's it. Right, and so what we got here, interestingly, look at this, we come to this fib extension here, and oh, hey, it causes some trouble. Same here, and then here, oh man, we got up to this one, and somehow we initiate some global lockdowns right then. Causes some trouble. I thought these are all pretty interesting. Anyway, so 2011, this is what's going on here, is the European debt crisis. So there are a bunch of countries like Greece, other countries getting issues with debt. They're going to default, right? This is all still Great Recession sort of ramifications. And then U.S. credit downgrade by S&P. This was the time that the Congress could not agree to, or eventually did agree, but had issues agreeing to raise the debt ceiling. And there was some brinkmanship. Basically, they downgraded our credit of the United States. So that caused all this kind of turmoil here. But you can see, even so, pretty good moves coming out here. Right when this did dip below, it came back up. This is one of those times that if you did go long when you went in, you might not have felt very good. But I do recommend anytime, or at least the strategy I'm going to implement would be, if you go long when you enter, right, take some profit back when it clears, because you don't know what's going to happen. This could happen here. And you end up holding longer than you want to. Eventually it did clear, worked out, didn't make it to the mid put, but the next time it did. This little bounce here, pretty decent, went to the middle of your EMA. Same thing here, this one came real close to your mid put. If you were using that as your target, it didn't quite make it, but it's close enough. And then, like I said, so these are some pretty long moves, but shallow. Okay, 2015 China debt crisis was going on during this time frame. So this was a pretty severe move through here. Notice this fib level tried to hold up but couldn't. So you got a severe move. You could have went long here, like I'm going to suggest, and hey, look at this. Got a pretty solid move up through here. You could have taken profit up here, but we closed the day under, right? So here, when you clear the -1 ATR range, right, you closed. Now you can be pretty confident, based on all these charts we looked at, that you're probably going to get some sort of move. So here we go. We made it back up past the mid put before stalling out and coming back down. We hit it again. This one was more just a bounce back to the mid put, and eventually, if you held on, it did go all the way back up to the put trigger before bouncing a third time off of that down into this below here again. But you clear your ATR and you get this. It's pretty nice move up here. All right, Brexit. So here, economy tried to recover, it fiddled around with this fib level again, and Brexit. Are we having Brexit? Oh, no, we're not having Brexit. Yes, we are. No, we're not. Yes, we are. Right, that went back and forth, which is what all this instability was about right here. But anyway, here we get under it, we clear it, and we kind of ride along it for several days. It would have bounced a few times here. You could have played these bounces. That's not something I really would want to get involved with, but if you did go along when it cleared, and you hopefully wouldn't get stopped out because it didn't close under, you did get a nice move up to the mid put eventually. Here you got a nice bounce off of it here. Since you had this move already, I would not go long on going under it. However, since you could see that it bounced off, you would think you probably get a nice move, which is to go to the mid of your ATR cloud, or sorry, your EMA cloud, and then this move, say this one is kind of a precursor to this. It gets down into stays here for a few days, hits the mid, or the first extension, and recovers back up to your mid put, right? So you get a pretty good move off this one. That is a 12% move from clearing all the way. Here's your mid put. That's probably where you might want to take profit, but this move did continue on. Okay, 2018. There's a China trade war going on. The Fed was tightening. They kept raising interest rates. Eventually, they backed down. May or may not have something to do with the president trying to figure out if you could fire Jerome Powell. But anyway, there's a bunch of stuff going on with that, and we got over it eventually. But either way, we hit this. We bounce all the way back up mid put. You'll notice this keeps happening, right? Here, got below. We went all the way down to this second extension, and then like this, we clear this. Pretty violent snapback here. Again, we stay below it for a fair amount of time here. Here, maybe you got tricked because it did close above, which is why later when I talk about how it would use this, you would probably want to stop out here when it gets back below, right? If this is your your risk level, then we would have got stopped out here, but you could have got tricked right here. All right, and then eventually we come back, we hit this, come back up, we got a nice move up to here. You would have wanted to get out at this mid put, which is where this little what we call it, shooting star candle here. So if you took it here, luckily you got a nice gap up and you could just get out here, and then that signaled this terrible move here, right? This is one of the worst. Down below the -3 ATR here, and it doesn't try to clear it at all, but you clear it when the ATR shifts, and lo and behold, you get a nice move. This one at the end of 2018 actually gave you a good almost 20% move. I mean, you would have had it held down for a while. So if you're if you're just looking to, I don't know, clear the EMA cloud right here, realistically, this I would say is probably the local high. But if you held through all this, either way, if you give it about 10 days, a week, right, you would have gotten this one. So that would have been a nice move. Okay, 2020, we get the global lockdowns. Interestingly, hits this bit of extension and crashes. Weird. But yeah, we get this move under here, comes back up, hits this mid put level. I'm sure people were happy, like, okay, great, it's ending, but no. All right, you get this violent gap below here, and this is some of the most violent, just disconnected moves. So many gaps, it's just ridiculous. It hits this -2 ATR, and here it's like, well, maybe maybe I'll hold. I tried. I got back up to the extension, but then finally gave up. This was below the -3, close to the -4 extension down here. But then, the Fed to the rescue. I don't know how you would have known that this was a bottom. It did make a kind of a hammer candle, and I guess if you're probably paying attention to the world events, you might have realized that the Fed was stepping in, and you could have went long here. But anyway, here this ATR rate shifted. You got this nice gap down, which probably could have led to your thesis that price is going to go up. But even though you had all these gaps here that didn't do that, so it's hard to say. This one probably would have been one of the hardest ones to convince yourself to go long on, just because of the macroeconomic conditions. But if you did, you got handsomely rewarded by this move of almost 30% in about 20 some days. Sorry, 68 days. Right, so a long time for that move. Probably more reasonable would be you call it here, which is in 2 weeks ish. Okay, and here we are, present day. Call this one a 3, but in reality, you got the level. It did close back above the level. It kind of skimmed it for several days, but look at this, all the way up here. It did the mid-put trigger, or mid-put level, and it, 4.5%. This next one, once it clears, gives you about 5.5% at the same place. Okay, and then we have the ATR does shift because we entered a new quarter in April. It hits the level here. I actually did play a couple of these moves because I was actually, this is when I started noticing this pattern, right? So here, I said, no way, right? This isn't going to close here, and I believed it. Went long here, got handsomely rewarded by the end of the day. Had I held for a couple more days, right, this was a very, very nice move. Believe this is when the Fed came out and said some things that everyone was really happy about, but then they realized maybe this isn't so happy, and we dumped below it again, and we're just now coming back above. So I kept this move out of my data because I don't know where this is going to end. There are a few more days to add on to this one, but the fact that it did close above technically, but now we're closing below. So you've seen some instances similar to that, maybe even over here, where we could say that this is a pretty similar move. This could result in this snapback in that case. If it does, then you might get all the way back up to this level here, which is pretty much in confluence with these levels. These highs here, which if you look over the SPY is about 427. So that does seem like a reasonable target based on what's happening right now, but there's really no way to know when this move will end until it does. So like I've said a couple times, wait for your close above the level, right? These days we are not closing above this, so I would not suggest going long at this point. Alright, so that was the historical perspective. I gave you some, showed you a bunch of times what has happened and what sort of ideas I had as far as how I would have played a lot of those. So here's how I would handle this as far as real time. How is this happening? Right? Identify what kind of interaction you have. Remember, you got a really good chance of it being a 1 or a 2, 62%. Additionally, like I pointed out, 3 or aboves are almost always preceded by a 1 or a 2. So if you are just getting your first interaction with your -1 ATR level, it is very likely to be a category 1 or 2. I didn't cover this yet earlier, but if the moves are related, in my opinion, until you've gotten above the put trigger, Okay, so using this information, right, like I said, you can probably assume that you're going to recover back above the ATR within a few days, probably by several percent, right? So average time under, you know, 4 days for your category 2s. How much a rise do you get? Like I showed you earlier, about 5 to 6%. And then is it going to reach your put trigger, mid put trigger? I mean, looks pretty likely. So here's how I would handle that, right? So you've reached the -1 ATR. Go long. How long a time? I would say probably give yourself a week, based on all the data we looked at. That's a good time frame. Something will probably materialize within that week. You may not reach your mid put trigger. So I recommend being pretty nimble on these. Be flexible. I would keep the size small, right, in case this turns out to be a category 2. So that'd be kind of where you would first enter. If it is a category 2, you're going to go below your -1 ATR. So not your ideal entry. You're kind of going to add in, right? So once you see some reversal signs or you reach that first ATR extension, you could add into your position. And then if you do add down at the reversal or the -ATR, I would take profit up at the -1 ATR once you clear that, even if it's on a intraday basis. Clearing it just looks like a good place to take profit to me. As a reminder, this only makes sense if this is the first interaction with the -1 ATR. I would not be trying this because your chances increase that it is a much worse move. So keep that in mind. Right, so here's an example from January. You actually have a good entry point the day before, near the end of the day. Wake up, oh no, I got down. Let's add here. Seems counterintuitive, maybe. And then down here, you got this long wick candle. This is a 15-minute scale, right? You got this long wick, and it looks pretty good as far as reversing. All right, so if you were, you know, feeling spicy, you could add down here. You clear it. This even clearing this first extension might be a good place to take profits off here. You don't really know what's going to happen, so I would consider that. Right, and now, boom, I've cleared the -1 ATR, take some profit. Because you see what happened is it turned back around. I did turn off extended hours, so this is just regular trading hours when you'd be able to work with options. Yeah, but what happened is you closed above, but then you gap back down. So again, we only go down to the first extension here, which again, you could just add to your position here. It might be uncomfortable, but you could do that. And look at that. Same. This is the next day now, after this day, right? You could take profit again, and then here we're just sort of sitting above here. Doesn't really have much direction. You do have kind of this reversal pattern here, right? This green bar, the large upper wick, right? Inverted hammer. So this might have said, you know, maybe I should just get out here. You could do that. I wouldn't fault you for that. But you get more chances, right? You get back to this extension. You could add, take more profit once you've cleared it. Add again, take some profit, and then finally we've reached the mid put where you would I would at least scale out above your position. There isn't much of the move left. Okay, so things to avoid. Right, look at this. We talked about this earlier, but this is bad. It broke through the second extension. If you're adding at this first extension, then I would use, sorry, this is the first extension. If you add at the first extension, I would just use the second one as a stop loss, just because this, it gets below here, it's going to be a real stinker of a move. It's probably going to take longer, right? So this is unfortunately one of the few times that it just goes straight into well, category 5 without getting a category 1 before it, or 2. So you could have gotten tricked here thinking, okay, go long here. Okay, add here. Okay, this is where I would say this move is invalid at this point. Okay, so that was my first idea. Other idea I have here is when you're exiting, right? So you're exiting the ATR range. You didn't have an ATR shift. So here's what I would do, right? Wait for a close above. This is going to act as a resistance level. You might pop above, below a few times. So I don't suggest going long until you have a close above. They'll avoid getting a lot of the fake outs that you might have seen along the way, right? Again, once you've got your close, go long. I would target your mid-put ATR level, and then you could use that -1 ATR, maybe a little below it as a stop, right? Because that, in theory, should be acting as a support level, right? So if you want to not get stepped out as easily, maybe make it a little below that, but too much below it, and it looks like you are probably in some sort of worse move than you might have initially thought, right? And then as you saw, as we went along, I had the pivot ribbon up, but whatever moving average or EMA you're using, I would take some profit there because, well, that's just a good thought, right? You got extended from it. Once you hit it, it may act as some resistance, may bounce you back down, right? Take some profit and be ready for it to reverse. But based on what we've seen, a lot of them will reach your mid put level, and then these moves can take longer, right? So this is definitely some sort of swing position that I would enter, not necessarily a day trade, right? You're looking at a week, 10 days, even more, right? Depending on what sort of move you just had, right? So that's why it's important to identify what kind of move you're in to know how long you actually want to hold this. And like I said, if you didn't have an ATR shift, you're more likely to be in the 10 range. But if you did, you're looking at 30 days, right? So this could be a long-term move. Okay, so here's an example from this is 1997. So 3-1, right? This you could do it as your previous example. This says 3-1, but it's actually 3-2. Sorry about that. Right, this one did hit your second extension, so you might have been like, oh no, I should cut this, but look at this violent reversal, right? So if you did hold, you did pretty good on this 1 day, 3-day move here. 2-8, another deep bounce, but you hit this dip here, so I would not have gone long on this. Close here, I would have waited till it cleared, and then you get a few days. This is actually one I covered earlier, but it goes across 3 days. It stopped out. Hopefully not, but it did clear it eventually. And then lastly, your ATR shift, you're probably in a really deep move. Here you could go long at the first candle like I did, get a lower entry time frame entry. You got about a week, you'll get higher. Take care, you may only get one candle, so you got to be nimble on this one. They often symbol the end of a move can be where the biggest moves occur, but they might lead to further downside. If they do lead to further downside, you'll get a slight upside first. So for those ones, especially from the deep moves, you might want to get a longer time frame. And in case it goes against you, you're not that out. But right, 30-day plus swing would be my thought on these ones. And then give it, say, a week, unless you get some real gnarly action, because it seems like it's going to recover. And as always, be nimble, take profits. Don't hold too much, right? You'll find some good levels to take profits, right? So example from 2008, 2009 area, kind of covered this one. It came out of the ATR, and you did get a nice little move here before coming down, right? And you may actually, from this, it was actually the call trigger of the new one, so you could have seen this was probably going to be a resistance. Take some profits at that. Okay, so in conclusion, I think this is a powerful strategy. I'm going to be adding it to my toolbox. I've already used it a little bit, but now that I fully analyzed it, I think I know some pretty good ways to use it. This is about probabilities. It can fail, but rarely does if you position properly, right? So, yeah, if you go all in on a day trade, thinking it's going to bounce this one day, it probably won't. You probably won't like it. But only one of these is really what I considered an actual failure. And then this may end up being uncomfortable, might not be for all risk profiles, right? If you can't hold through some pain, I'm not necessarily going to recommend this to you. And that's really all I have. Thanks for going through this with me. If you have any other questions, I can get you the whole data set. If you want to look at it yourself, feel free to review the charts, point out anything to me that I might have missed. I appreciate it. Hopefully this is useful, and I may look into doing more stuff like this if people enjoy it. Thanks again.